Hey everyone, this is Deep Dive Stock Earnings. Today we're taking a closer look at NIO, because the company just released its latest quarterly results along with fresh delivery numbers. And there's a lot here that investors need to unpack. The last few months have been full of ups and downs for NIO, but this new update finally gives us a clearer picture of what's actually happening under the hood. I'm going to walk you through all the key data points, explain what they really mean, and tell you how they could shape NIO stock moving forward. Let's start with the headline number, vehicle deliveries. In the most recent quarter, NIO delivered 87,000 vehicles, which represents 41% year-over-year growth. That's a strong result on its own. But what's more impressive is the trend behind it. Deliveries have accelerated every single quarter this year. 42,000 in Q1, 72,000 in Q2, and now 87,000 in Q3. That's not random growth. That's a clear upward trajectory, and according to management, this momentum is expected to continue. They're forecasting 120,000 to 125,000 deliveries for the fourth quarter of 2025 if they hit the range. We're looking at another major acceleration. But here's something interesting. Even though deliveries grew 41%, vehicle sales revenue only increased 15%, and there's a simple explanation for that. NIO's product mix has changed. The company introduced lower price brands like NIO and Firefly. These models sell at significantly lower average prices than the premium NIO lineup. So even though unit volume is rising fast, the revenue per car is naturally coming down. That's not necessarily a bad thing. It's part of their brand strategy. But it does explain the disconnect between delivery growth and revenue growth. One metric that really stood out to me this quarter is the vehicle margin. NIO reported a 14.7% vehicle margin, up from 13.1% in the same quarter last year for an EV company. That's extremely competitive. Traditional combustion engine manufacturers can get higher margins, but in the pure EV space, very few companies operate consistently at this level. This shows that NIO is doing a better job controlling costs, managing its supply chain, and optimizing its product strategy. Now let's talk cash. A short while ago, NIO raised capital through a stock sale, bringing total cash on hand to about $5.01 billion USD as of September 30th, 2025. That gives the company some breathing room. More importantly, NIO reported positive operating cash flow this quarter. If they can't maintain this, it could mark a real turning point, a moment where NIO finally steps away from the raise more money every year cycle it's been stuck in since it began aggressively investing in new models, RD, charging infrastructure, and battery swap stations. Operating losses also improved meaningfully. The company reported a 3.5 billion RMB operating loss this quarter, compared to 5.2 billion RMB in the same period last year. Still a loss, but clearly moving in the right direction. And even though we don't have the full Q4 results yet, we already have a taste of what's coming. In October alone, NIO delivered 40,000 vehicles, a record for the company. Management says this pace will continue and possibly improve through the rest of the quarter. If they do hit 120,000 to 125,000 for Q4, that would represent 65% to 72% year-over-year growth, which would be both a record and an acceleration from the current quarter. We also need to touch on one of NIO's long-term advantages, its battery swap and charging infrastructure. One of the biggest barriers to widespread EV adoption globally is simply how long it takes to charge a battery. People who can't charge at home don't feel this pain, but the majority of the population still relies on public charging stations. And when you compare minutes at the gas pump to hours of charging, the gap is brutal. NIO's battery swap technology solves that. Instead of waiting to charge, you just pull in, swap the battery, and leave often in just a few minutes. The system is something NIO has spent years building and investing in, and it remains one of the strongest differentiators between NIO and every other EV brand. As delivery volumes grow, the value of this infrastructure grows with it. Now, the company's ability to generate consistent positive operating cash flow will become crucial. If NIO can maintain this, investors will start to de-risk the company and treat it as a more stable, self-sustaining business. That would be a major sentiment shift, but there's still a downside we need to acknowledge. Just 1 or 2 months ago, NIO raised another $1.16 billion by selling stock. That increases the share count, meaning that even if the company becomes profitable in the future, those profits will have to be split across more shares, which dilutes earnings per share. This is exactly why investors want NIO to stop raising equity and start living on its own cash flow. Overall, the outlook for the fourth quarter looks strong. If NIO can deliver between 120,000 and 125,000 vehicles, the market will absolutely react to that, and likely in a positive way. Growth would not only be strong, but accelerating. At the same time, my overall view remains cautious. NIO is improving margins, deliveries, cash flow, all heading in the right direction, but I still want to see more stability before I would consider upgrading it to a buy. The EV industry is highly competitive, capital intensive, and unpredictable, and personally, I tend to hold automotive companies to a stricter standard. That doesn't mean NIO is a bad company. It simply means I need more consistency before I can be fully confident in the long-term trajectory. But for this quarter, NIO did what it needed to do. The fundamentals are improving, the growth is real, and the next few quarters could determine whether the company is truly turning the corner. That's my full breakdown of NIO's latest earnings and deep dive stock earnings. Thanks for watching, and I'll see you in the next one.